Hi, welcome to Property Insight. My name is Mark Ashworth.
I'm Neil Harding.
And on today's video, we're going to be talking all things capital gains tax. So the tax that you have to pay when you sell an asset, namely, obviously in this particular context, an investment property. So as you're the tax guru, Neil,
right?
Let's talk tax and capital gains.
I will try and keep this as interesting as possible, even though it has the word tax in it. So capital gains tax, as you said, it is paid if you are selling an asset. So payable at the point of disposal, and it's payable on property that you own in your own name. Companies pay corporation tax if they sell a property. If you own a property in your own name, you will be paying capital gains tax on it, assuming you have made a gain. And something that I see on Facebook threads and in networking events, get questions all the time about, well, what's my capital gains tax bill? And I want to start off by saying that there is a .gov calculator website for capital gains tax, which is free and very useful. So crack on and use that. It's a great resource, and that will give you a good indication of what your capital gains tax bill is. Also seek proper property tax accountant advice. So what I'm about to say is not tax advice, but hopefully it will give you some basics and an idea of the sorts of bill that you might have to pay. So capital gains tax is payable at 18% or 28%. This is 2023. They're the rates in place at the moment. On the gain that you've made. You don't pay capital gains tax if you haven't made a gain on the disposal. Okay. Now, the gain is calculated by taking in simple terms, the sales price, actual sales price, property sold price, and deduct from that the purchase price of the property. Okay. Now, that's the most simplistic sort of calculation that you can have. So let me just sort of run through some numbers, and you can see why it might get a little bit more complicated than that, and why I think some people sometimes get a bit misled and confused about what it is that their gain actually is. So if you've got an agreed sales price, let's say of £200,000, someone might think that the property was worth actually £230,000 is what they thought the market value of the property actually was, but they've got an agreed, say, arm's length transaction that they're selling a property for £200,000. Let's say they originally purchased that property for £120,000. Okay. And let's say they purchased the property partly with a mortgage, partly with cash. So maybe there's a mortgage of £80,000 and cash of £40,000 to buy that property for 120 originally. Let's say they purchased a property 5 years ago, back in 2018, and they thought it was an absolute bargain, and they thought it was £140,000 at the time. So they got a £20,000 below market value deal. Fantastic. And let's just say that their current mortgage balance is £110,000 because they've since remortgaged a few times, taken a bit of equity out. And also, just to keep things simple, I'm going to assume that this person has never lived in the property, okay, and has always been tax resident in the UK. All right, just to keep things simple. So in that scenario, what's the capital gain? Okay, well, in simplistic terms, the answer is £80,000, probably. So the emphasis there is on probably, but the £80,000, as you may already have realised by now, it's a sale price of £200,000 less the original purchase price of 120. Okay, £80,000 gain. The reason why it's probably is because, as I said before, do seek proper tax advice for your individual circumstances, because there might be all sorts of reasons why the answer is not exactly £80,000. So if you've lived in a property, it's going to be a different answer. If you're not in the UK, if you're not based in the UK, it's probably going to be a different answer. If you're selling the property to a connected person, maybe it's a family member, especially if you're selling it for a value that is significantly less than market value, it's probably not going to be £80,000. It might be the market value that's deemed. Anyway, all sorts of reasons why you need proper advice. Let's just have a quick look at what is included in the purchase price. Okay, so in that example, the purchase price was £80,000. You'll be including a number of other things within that. So you've agreed to buy the property at £80,000. Add on to that the stamp duty land tax, or stamp duty, okay, that you'll have paid at the time. That's a capital cost. and add on to that also the solicitor's costs that you would have incurred that were directly related to the purchase of the property. Not necessarily the financing of it, but the purchase of it, the conveyancing. And also add on to that any capital improvements that you may have incurred during the 5 years that you owned that property for. So if, for example, you've done a buy, refurbish, refinance type project and you've put in a new kitchen and there was no kitchen in there whatsoever when you purchased the property, that's a capital improvement. So that's not an expense that you've incurred in the year that you just deduct from your income tax return calculations. You've improved the capital value of that property by the £5,000, let's say, that you spent on the kitchen. Okay, what have you actually sold the property for? So in this example, you've sold it for £200,000, but you're allowed to deduct from that a number of costs which would reduce your gain. So you've incurred probably more legal fees, and you've probably incurred more estate agency fees as well. So it might be 1%, 2% estate agent fees. Deduct that from the £200,000 before you arrive at your capital gain calculation.
So I think that's quite a lot to, even though you said you were going to keep it simple.
Try to keep it simple.
But one thing that you did mention, which is interesting, which is if you were to put a kitchen in where there wasn't already one, it was a capital expense. Rather than going into detail now on this video about capital versus revenue, capital versus revenue costs, we'll do another video on that at another time, and then we'll be able to talk to you about what's included in what you can deduct from your normal tax bill when you refurbish a property. But in brief, it's typically anything that you replace is a revenue expense, and anything that you improve the property with is a capital expense. So if you go in and you change the carpets on carpets that are already there, that's typically a like-for-like replacement, comes off revenue. Whereas if you do an extension, for example, then that would be considered to be capital improvement, and you're not able to deduct it from your typical revenue expenses in your year-to-year tax return, but you would deduct it off the selling price when you sold it at the end. So it is deductible, just at a different stage of the game, right?
Correct, absolutely. Yeah. Last thing that I want to say is it is payable within 60 days.
This is your capital gains tax bill.
The capital gains tax bill is payable within 60 days from the date of sale. For capital gains tax purposes, that's taken to be the date of exchange of contracts, not your completion date. So that's important. So the 60 days starts counting from that point in time. Okay.
Have fun paying your capital gains tax bill, guys. We hope you found that very insightful, and we'll see you on the next one.